$1 trillion. That's roughly how much S&P 500 companies spent buying back their own stock in 2025 alone. Not building factories, not hiring engineers, not developing new products, buying their own shares off the open market, quarter after quarter, like a game character dumping all their gold into a single stat boost. And here's the part most investors never think about. That $1 trillion doesn't just return cash to shareholders. It creates a persistent, invisible bid underneath stock prices. A floor that feels permanent until the moment it isn't. To understand what's really happening, you need to see buybacks not as a corporate perk, but as a piece of market architecture. A structural support beam that most people don't even know is load-bearing. Here's the basic mechanic. When a company buys back its own shares, it removes those shares from the open market. Fewer shares outstanding means each remaining share represents a slightly larger slice of the company's earnings. So even if the business earns exactly the same profit this quarter as last quarter, earnings per share goes up. The company looks like it's growing when really it's just shrinking the denominator. It's the financial equivalent of making the health bar shorter, so it always looks full. And this isn't a small effect. In Q1 2025, S&P 500 companies set a quarterly buyback record at $293.5 billion. About 14% of those companies reduced their share counts enough to boost their earnings per share by at least 4% year over year. Not from selling more, not from cutting costs, just from having fewer shares in the equation. That's not growth, that's arithmetic. Now, the standard argument in favor of buybacks is straightforward. A company generates more cash than it needs for operations and investment. Rather than sitting on the excess or paying a dividend, which commits them to an ongoing payout, they buy back shares. It's flexible, it's tax efficient for shareholders, and if the stock is undervalued, it's arguably the best use of capital available. This is all true. But here's where the system design gets interesting. Buybacks don't just affect the companies doing them, they affect the entire market's supply and demand structure. When corporations collectively spend $1 trillion a year purchasing equities, they become one of the single largest sources of demand in the stock market. Not pension funds, not retail investors, corporations buying their own stock. And unlike most other buyers, they're not reacting to price signals the way a normal market participant would. They're not buying because they think the market is cheap. They're buying because they have authorized programs, approved budgets, and often pre-scheduled trading plans that execute automatically. This creates something unusual in market structure, a buyer who is somewhat price insensitive. When markets dip, buybacks can accelerate because companies are getting more shares for the same dollar. When markets are calm, buybacks flow steadily. The result is a constant bid, a background hum of demand that dampens volatility and nudges prices upward. Think of it as a buff that's always active. You stop noticing it's there. You build your entire strategy around the assumption that it will always be running. And then one day it isn't. That's what happened in Q2 2025. When tariff uncertainty spiked and corporate confidence dropped, buyback spending fell 20% in a single quarter. Participation dropped too. Only about 67% of S&P 500 companies were buying back shares, compared to nearly 77% in Q1. The bid thinned out, not because the companies were in financial distress, not because earnings collapsed, just because the strategic calculus shifted and discretionary buybacks got paused. And this reveals the critical design flaw in how markets have come to depend on buyback demand. Unlike dividends, which companies treat as near-sacred commitments, buybacks are discretionary. A board can authorize a $60 billion program and then quietly execute almost none of it. There's no penalty for stopping. There's no obligation to continue. The floor under prices exists entirely at the pleasure of corporate management. And that pleasure can evaporate with a single earnings miss, a policy shock, or a shift in how capital gets allocated. There's another layer to this that makes the system even more fragile. Buyback activity is extraordinarily concentrated. The top 20 companies in the S&P 500 accounted for roughly half of all buyback spending in recent quarters. Apple alone has been responsible for more than 10% of all buybacks in some years. Information technology as a sector represents more than a quarter of total repurchase dollars. So when people talk about $1 trillion in buybacks supporting the market, what they really mean is a handful of mega-cap tech companies are doing most of the heavy lifting. If those specific companies slow down because they're redirecting cash to AI infrastructure, or because their stock prices are so high that buybacks barely dent the share count, the structural bid weakens disproportionately. Amazon is a useful case study here. The company authorized a $10 billion buyback program in early 2022. It executed some repurchases that year. Then it stopped entirely. As of late 2025, it still had over $6 billion remaining in that authorization, untouched, while capital expenditure roughly doubled from $64 billion to over $100 billion annually. The buyback authorization still exists. The buying doesn't. On paper, the program is active. In practice, the bid is gone. There's also the question of timing. Most companies voluntarily halt buybacks during earnings blackout periods, typically starting a few weeks before their quarterly report and lasting until a couple days after. This means 4 times a year, roughly half the S&P 500 by market cap goes quiet simultaneously. The structural bid doesn't disappear, but it thins significantly. Some estimates suggest about 60% of buyback programs run on pre-scheduled plans that continue through blackout windows. But the discretionary portion, the opportunistic buying that tends to be the most price-sensitive, pauses entirely. Now, the academic research is genuinely mixed on whether blackout periods cause measurable market declines. Some studies find no significant effect. Others note a meaningful correlation between buyback activity and short-term market returns. The honest answer is that in a market with many sources of demand, one source temporarily stepping away shouldn't be decisive. But in a market where one source has become dominant, the math starts to shift. And that's exactly where we are. Corporate buybacks now exceed dividends by a substantial margin, roughly $1 trillion in repurchases versus $750 billion in dividends in 2025. This is the 5th consecutive year that buybacks have outpaced dividends. The culture of capital return has structurally shifted toward the more flexible, more discretionary, and more easily reversible option, which means the support it provides is also more flexible, more discretionary, and more easily reversible. There's a quiet irony in all of this. Buybacks are often framed as a sign of corporate confidence, and in many cases they are. But they're also a sign of something more ambiguous, that companies have decided the best investment available is their own existing stock rather than any new venture, product, or expansion. When a company says, the highest returning use of our capital is to reduce our share count, what they're really saying is, we can't find anything better to do with this money. That's not necessarily alarming. Sometimes the stock genuinely is the best bet. But when an entire market is doing it at record scale, it raises a structural question about where future growth is actually supposed to come from. The system as designed works fine. As long as the cash keeps flowing, the authorizations keep getting renewed, and management keeps choosing buybacks over alternatives. But every dollar spent on buybacks is a dollar not spent on something that generates new revenue. And the moment companies face pressure from any direction, rising costs, falling margins, political pressure, tax changes, the need to invest heavily in a new technology cycle, buybacks are the first line item that gets cut. Because they can be. The 1% excise tax on net buybacks that went into effect in 2023 has been, by all accounts, a rounding error. It reduced operating earnings by less than 0.5%. But the ongoing conversation about increasing that rate to 2 or 2.5% has corporations paying attention. Not because the current tax matters, but because the willingness to tax buybacks at all signals that the political calculus could shift further. What you're left with is a market architecture where a massive source of demand is neither guaranteed nor structural in the way most people assume. It's conditional on earnings, on cash flow, on policy stability, on management discretion, and on the absence of better alternatives. It's the largest single bid in the equity market, and it runs on a series of choices that can all change at once. If this kind of systems-level breakdown changes how you think about markets, consider subscribing to 8-Bit Economics. Every week, we strip complex financial systems down to their core mechanics. No hype, no predictions, just the underlying code. Hit subscribe, drop a like if this shifted your thinking, and leave a comment with your take on whether buybacks are propping up the market or reflecting genuine value. By the time everyone sees it coming, the smart play is already over. The uncomfortable truth about buybacks isn't that they're good or bad. It's that they've become load-bearing infrastructure in a market that treats them as optional. The trillion-dollar bid is real. It's powerful. And it exists entirely at the discretion of the people who can withdraw it without warning, without penalty, and without asking anyone's permission. The floor is real until the day someone decides to stop paying for it, and the only people who won't notice are the ones who never knew it was there.